Good morning. Right. Shall we start? So this is your first day, right? Okay. Then what's your name? Osam. Sabit. What? Right. So I am your fundamentals of finance lecturer, and there are 14 chapters, which means per chapter we are going to teach 2 hours. And additionally, you need to do the self-study as well, right? So that's the thing when it comes to a degree, you need to do the self-study also. Clear? Right. So let's start with the introduction to finance. Right. So this is your subject. What's the subject? Fundamentals of finance. So, right. So throughout this chapter, we are going to study about the finance, what is finance and what is financial management. There are two things, finance and the financial management. And also the role of the financial manager. In an organization, there is a person called finance manager, right? Therefore, as a finance student, you need to understand the role of this financial manager. Clear? And also, form of business organizations and the financial decisions. That is the main thing you should understand, right? And the goal of this finance and the agency problem as well. Okay. So this is your course outline. So for lectures, we have how many hours? 28 hours. Clear? So this is what then? 67. Individual student learning time, which means you need to do what? Self-study as well. Clear? You need to search from Google's books, articles and all. And this is the assessment method. You will have two tests, classroom tests, right? So each consists of 10 marks, and also you will be given an assignment. Through that you can score 20 and also one quiz, right? And the final examination, you will get 50 marks. This is your assessment method. Clear? Right. Okay, let's start then. What is finance? Without looking at this, just try to say what is finance. Simple idea. You also do some financial activities, right? In your day-to-day lives. So just tell me, what is finance? No, you are saying that. We are getting money, we are to put it. Very good. You are saying the definition of accounting. In accounting only we do the record the transaction, summarize and report all. No. This is finance, separate thing, which means this is about, right? This is about how you are going to acquire money, right? How you are going to use it, as well as how you are going to invest those money. It's about funds, money, financial resources, right? Finance is about what? Financial resources. How you are going to acquire means how you are going to raise funds, as well as how you are going to use those funds, and also what? How you are going to invest those funds to gain returns. Return means benefits. Clear? This is what finance is. You all clear, right? Right. So it can be done by individual, businesses, and government entities as well. So this is finance. Then what is financial management? You know the definition of finance. Then what is financial management? What is management?
The person who controls the resources, financial resources.
Yes. What else?
Make a friend
Yes, you are almost there. Which means, management consists four components. Can you remember? From planning to control. Yes.
organizing,
Right.
leading control.
Leading and control. Those are the four components of management. So if you apply those management components to the finance or your funds or your finance resources, that is called what? Financial management. Clear? So financial management is the managerial activity. So you know what are the managerial activities involved? Planning, organizing, leading, and controlling. Right? Of what? Controlling of firm's financial resources. Is that clear? So this is the definition of finance. This is the definition of financial management. Clear? Do you have any doubts? No. Right. There are some other definitions as well, right? You can, if you ask to write the definition or explain the financial management, you can use these three or the previous one as well, right? So what is this? Financial management is concerned with what? Acquisition, financing, and management of assets with some overall goal in mind, right? Keep in mind, when you are making financing decisions, record ചെയ്യില്ല. No, no, right. What is that? Concerned with acquisition, financing, and management of asset with some overall goal in mind. You know, when you're making finance decision, you should have a goal. What is the goal? Gaining interest. Those are the goals, which means simply you should gain some benefits, returns. Clear? That's it. And the other definition, the management of the financial aspect of the enterprise, it is concerned with the management of cash flow of a firm to make what? To make profit to owners. In a company, as a financial manager, this is the fundamental goal, right? To earn profit, to make profit to its owners or the shareholders of a company. So that's the finance. And also, financial management concentrate on the process of making financial decisions, right? In a way that maximize the welfare and the benefits of the firm's owner, which means wealth maximization of your shareholders. Clear? Wealth maximization. So you can use one of the definition. Is it clear? No doubt, right? Okay. When we talk about the financial management, right, we need to make three kind of decisions. How many? Three. One is investment decision, the other one is financial decision, and dividend decision. Those are the three decisions you should make if you are a financial manager of a company, right? So, investment decision is what? Where you are going to invest your money, right? You need to decide the optimal investment, right? What investment should the business take on? Or else you can say what? Where you need to invest your money, invest your fund. That is about investment decision. Next, finance decision. What is involved with finance decisions? Finance decision, simple idea. From where you're going to raise funds for your investment purpose, right? Just give me an example from where you can take funds.
Yeah.
Very good. From by issuing shares. What else?
Bank.
You can obtain bank loan, right? Is it clear? Those are the ways you raise fund. It's involved with finance decision. The third one is dividend decision. Then what is dividend decision? How to divide? What?
Profit.
Yes. You are there. You are almost there. What? You know, in an organization, very, yes, which you are right. Which means in an organization, we earn profit, right? If it is a company, we earn profit. From that profit, we can't pay all the profit to the shareholders. We need to make decisions about how much we are going to retain for our future purpose, future growth purpose, and how much from this profit we are going to pay as a dividend to the shareholders. That is about what? Dividend decision. Clear? Clear? Have doubts? No. Right? Simple then. Right. Investment decision. Assets in which fund will be invested. In which asset we are going to invest our fund, invest our money. Right? It has two things. Right? If you are planning to invest in a long-term asset or the fixed asset, what is long-term asset means?
More than construction.
Right, very good. If, right, the assets belongs, exist more than 1 year, we call it as what? Long-term asset. If you are planning to invest on long-term assets, we say it as capital budgeting decision. Clear? Same time, if you are planning to invest on short-term assets, very good. Everyday transactions. What are the short-term assets in an organization?
Sales and purchasing goods.
Very good. Inventory. Inventory is one of your short-term asset, right? That's why we record under current asset. So if you are planning to invest such kind of short-term asset or the current asset, we call it as working capital management. Clear? So tell me, if you are planning to invest in a long-term asset, what is that? It is capital budgeting decision. If you are planning to invest in short-term asset, it is working capital management, right? Okay. We have to say I helps. Right. Okay, capital budgeting. What is capital budgeting? Now you know. What is capital budgeting? Yes. Simply selection of assets, investments, or actions that will bring benefits more than 1 year. Right? Then it is called as capital budgeting. Clear? Right. So capital budgeting relates to aspect. Right. First aspect is you need to choose a new asset in which fixed asset or long-term asset that you are going to invest your money. That is about first aspect. Let's say now you have selected the asset, but unfortunately that asset is failed, right? If it is fails, you should be able to reallocate your capital, right? You should be able to reallocate your capital to some other assets. Clear? You need to choice, you need to select the asset. If that asset fails, you need to reallocate that investment to some other asset, right? So you know whether to accept or not an asset depend on what its benefit, right? Its benefits and returns associated with it. Let's say you have two options. When you are planning to invest, you need to assess no. There are so many options out there. You can invest on shares, you can invest on fixed assets, you can invest on some investment properties, building land or anything, right? You have several options, right? So when you select such kind of asset, such kind of option, you should determine what benefits of that investment or as the returns from those investment, right? For an example, let's assume there are two properties. There are two properties. Both properties requires same investment. Let's say you need to invest 10 million in this asset as well as you need to invest 10 million for this B as well, right? You have two options, but you only have 10 million. What is this? Economic knowledge you need to use. Scarcity. If you have scar, right, then you have a problem. What is that? Choice problem. You need to make a choice. If you don't have any scarcity in your resources, then you won't have this problem as well, choice problem. You can invest in all the assets, right? So now you have a choice problem. In which asset we are going to invest? Clear? So at that time, what is the determinant that we use? Which means we need to assess the benefits from these two. Let's say at the end of 10 years, right, this investment provide the return of 25 million, but this investment provide the return of 20 million. Those are positive, right? Those provide benefits, but you need to select one. Which investment is better? A. Because why? It gives us more return than this, right? These are the things we do under financing. No, investment decisions. There are three decisions. What are they? Investment decision, finance decision, dividend decision. Now you can explain those decisions as well, right? So this is one of the aspect of what? Capital budget. Need to choose the asset. If that asset fails, you should be able to reallocate that capital, right? And also, when you accept investment or select an investment, you should consider what? Consider about the return or the benefit of that investment. Second aspect is you need to analyze the risk and uncertainty. What is risk? Simply,
think that will occur goes bad.
yes, something that will occur those bad. Right. What about you? What is risk? You know, you are planning to something, but actually happen something else, right? Simply the difference between actual results or actual outcome and the expected outcome. Clear? You expect this investment will provide 25 million return, but at the 10 years, it provide only 10 million. So there is risk. Clear? Then what is the meaning of uncertainty? You can't predict the future. It's uncertain, right? So this is the second aspect. Somewhat you can, in working capital management, we make decisions for 1 year, right? So we know the exact date, we know the exact period, as well as we can predict somewhat, right? Because it's short term, no? The uncertainty when compared to this capital budgeting is low. But when it's come to the capital budgeting, we are planning for 2 or 3, 5, 10, right? Yes. So we can't predict such future. Clear? So second aspect is you must analyze the risk as well as the uncertainty related to those investments. Clear? That's the thing. So risk should be estimated. You should estimate the risk as well as you should compare the risk with your return. Compare what? Risk with your return. And the return should be greater than your risk. Clear? Then only you can select that option. Right? In the next, your second year, I think, you will learn how to calculate this return of an investment as well as how to calculate this risk of an investment. Right? So for the time being, just keep in mind return should greater than risk. That's it. Clear? Okay. How many online students are there? Only one. Samsung SM. Am I audible? Samsung SM S948B. Am I audible? Okay, then. No use of speaking with that guy. Right. Okay. So next, our working capital management. So now you know what is working capital management.
Then
Less than 1 year, which means you are concerning the management of current assets as well as current liabilities. You should maintain your current assets and current liabilities in order to meet your short-term obligations, right? If you properly maintain your cash only, you can pay your trade payables. Trade payable is what? Your current liability. If you properly maintain your cash, then only you can meet such kind of short-term obligation. Clear? That is involved in working capital management, right? All entity need liquid resources. What is liquid resources?
the asset can be turned into money quickly.
Very good. If you can convert your resources into cash quickly as soon as possible, we call it as liquid resources. So tell me, when compared to the cash or the trade receivable, is inventory a more liquid asset? When inventory, when compared to the cash and trade receivable, is inventory a more liquid asset? More liquid mean you should be able to convert it to cash quickly. Can you do that for inventory? Inventory take more time than the trade receivable as well as the cash. Cash is already it is in cash form now. Clear? That's why we record the inventory at the top of the current asset. Can you remember the order we record in current under current assets? Inventory. Inventory is in the at the top. Why? Because it is less liquid. It take more time to convert to cash, right? So in any organization, you should manage your liquid resources to fund working capital needs. What is working capital needs? Day-to-day needs, right? For day-to-day operations, you need fund. So that's why we need to manage these liquid resources. Clear? So short-term financial strategy involves planning to ensure enough day-to-day cash flow and is to maximize profit, determined by what? Working capital management. So it's about simply what? Managing, no maintaining your day-to-day cash flow. Clear? This is working capital management. Right. Now tell me, what is finance? What is finance?
From where get money and where is pool the money.
Simply,
Where they use.
how we are going to acquire, utilize, or invest your fund. Right? Then what is financial management?
How to get that? How to get money flow.
What is financial management?
How to plan and control the money flows are
Financial management, keep in mind, you always need to include the term management activity. It's a management activity
and
of planning and controlling the financial resources of organization. Clear? How many types of decisions we make on the finance? Three types. What are they? Dividend decisions. Very good. So, what is investment decision?
where to invest the money correctly.
Where or in which asset you are going to invest your fund, right? Always use the term fund instead of money. Clear? So, when you are making investment decision, you have two options. What are they? It involves with two things. Long term. Or if you are investing long term, we call it as what? Capital budgeting. If you are planning to invest in short term, working capital management. You all are good with that. Right. Here, you should have the balance of this current liabilities and current assets. Now you have the idea, right? Maintaining the efficient level of working capital for short-term survival. Efficient level means, yeah, efficient level.
We can do our 100%
With less wastage, right? You should not waste your funds. Let's say you have 10 million. If you invest entire 10 million for purchasing the inventories, that's a waste, right? We need to allocate the optimum. We need to select the optimum level of inventory. We need to invest on optimum level of inventory, optimum level of resources. Clear? So that's why we call it as maintaining efficient level, right? Can you remember how we all did the A levels name? We all did, right? So you know the inventory levels.
2:1. Say current asset to liability 1.
No, 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 no.
Higher,
You are telling the ratio, no?
higher, maximum, uh,
Maximum inventory level,
minimum inventory level,
pre-order level,
pre-order level,
minimum inventory. Can you remember those things?
EOQ.
Very good. EOQ as well. What is EOQ? Economic order quantity. Economic order quantity. Right. So why we use such kind of things? Why we need those things? For this thing, to manage your funds and resources efficiently. Clear? Right. Our next decision, just go through this as well, is financing decisions. What is financial decision? Simply from where you are going to raise funds, right? It can be in order to meet your short-term obligation or day-to-day operation, or else it can be for your investment purpose. From where you are going to collect those funds. It's about financing decision. It concerns with financing mix, capital structure, and leverage. Financing mix and capital structure is talks about how much debt capital you are going to use, as well as how much equity capital you are going to use. There should be a balance with these things, debt and equity. What is debt capital means?
Borrowing.
Very good. Long-term loans and all, those are debt capitals. You can issue, if you are a company, if you are a finance manager, you can issue for what? Debentures for debt instruments, right? Debentures, bonds, those are what? Debt instrument. As well as you can obtain bank loan as well, long-term loans. Those are debt portion, debt capital, or else own or equity. How you can raise through the equity? You, through your retained profits, as well as you can issue what?
Sale of assets.
Shares.
Yes.
You can issue shares as well, right? If you issue shares, shareholders will invest fund to the shares. That comes under what? Equity, right? Those are the equity thing. So you should balance those debt as well as equity to maintain the capital structure, right? So this is about financing decision. How to finance the asset required for the firm is the concern, right? So you need to use the optimum capital structure because if you, let's say you need 100 million, right, for your organization, but you don't have sufficient fund. Now you need to raise funds, collect funds. You have two options. What are the options? You can go for debt capital or else equity capital. But if you collect debt or equity capital, you have an expense as well. You have an expense. What is that? For debt capital, you need to pay repayment, the loan. Very good. You should pay the interest as well. And also, if you go for the equity capital, for that, what you should pay? Dividend. Very good. Right? Those are your cost of capital. Cost of capital. Let's say you have 10 million. If you entirely obtain or if you entirely collect this 100 million through the debt instrument, then you need to pay interest. Right? If you obtain this 100 million through equity, right, capital, then you will have to pay dividend. So you need to decide the optimum level. You can't go for one option. Why? Because if you go for interest, let's say if it is 10%, then you need to pay. Right? As well as dividend also, you need to pay. Those are we call as cost of capital. Clear? What? Cost of capital. So you can use capital structure theories. There are so many theories, capital structure theories we use to identify the optimum capital level, right? In how much we are going to raise through the debt capital, how much we are going to gain through the equity capital. Then only we can get the optimum structure. Clear? Because these two involves cost, no? You need to pay interest or else you need to pay dividend. Right? Is it clear? This is about financing decision. Next, what is the next one? Dividend decision. You know now. What is dividend decision? Yes, which means out of your profit, how much you are going to retain for your internal growth or the future growth, as well as how much you are going to pay as dividend to the shareholders, right? That's about dividend decisions. These dividend decisions affected by these factors. What are they? Growth of your company. If you are planning to grow your company, then you need to retain more fund than paying as dividend, right? If you pay dividend, then otherwise, then again you need to collect fund, no? Right? Therefore, you need to pay attention on those things. Growth as well as opportunities, right? Instead of paying dividend, right? You will have some opportunities to invest that profit to some investment to earn or gain returns, right? So those opportunities also you need to consider, as well as taxation and shareholders preference. You know, if you earn profit, you need to pay tax. For a company, there is a concept called double taxation. Can you remember? What is double taxation? You should pay tax on profit. Yeah?
Owner.
Yes. What is that? You need to pay tax on your company's profit as well as on your dividend. So, double taxation. Clear? So, if shareholders prefer, don't provide the dividend, just invest that fund into somewhere else, then we should do that thing because they are the owners, no? We need to respect their preferences as well, right? So, this is about dividend decision. You have profit, how much you are going to pay as dividend, how much you are going to retain for your future business. Clear? This is about dividend decision. Right. If you are a financial manager of an organization, you should try to answer for all those questions. From where we are going to collect funds, in which asset we are going to invest those funds, and how much profit we are going to distribute as dividend, how much profit we are going to retain for our future goals, right? For these questions, who should answer? Financial manager, right? So the top financial manager within a firm is usually who? The general manager finance. He is the top financial manager, right? So here is the role of financial manager. What are they? Raising funds and allocating funds, profit planning, and understanding the capital markets, right? You should understand the capital markets. Can you remember the capital markets? Do you know? There are types of capital markets. No worry. In the next chapter, we will learn those things. So, what are the roles of financial manager? Raising funds, allocating those funds, profit planning, right? And also understanding the capital market. Is it clear? No need to explain, no? Right. Modern forms of business. Can you tell me the forms of businesses available in Sri Lanka? Very good. Sole proprietorship, partnership, and companies, right? Those are the non-profit organizations, franchises, right? Those are the modern forms of business. So corporations means similar to company, right? A business created as a distinct legal entity composed for one or more. What is the meaning of legal entity? What is the meaning of legal entity?
Yeah, explain.
So to sue in the name of the company, not on the shareholders' name, right? If you know, legal entity simply means in the name of that company, you can make contracts. In the name of the company, you can file legal cases, right? So that's why this thing is very much important. Legal entity, right? Is this available for the sole proprietorship and partnership? Legal entity concept? No. Why? For the sole proprietorship, you don't have the legal entity. Owner should file cases on his own name, not in the name of the business. It is available only for companies. Clear? Right. So through this you gain these things. Separation of controls in a companies. Shareholders are the owners, but managers are the person who act on behalf of the shareholders, right? And ownership can be easily transferred. How? What's the way? Through shares. If you have 100 shares on particular company, if you need to transfer your ownership, then you can sell those 100 shares to someone else. It's easy. And limited liability. What is limited liability?
Shareholders will want to give their personal sense.
Right. If any bankruptcies or if any financial financial problems are there with the company, as a person, as an individual, right? If you are a shareholder of that company, you don't need to provide your personal assets to settle those obligations, right? It is limited to the number of shares you have. And double taxation, we have discussed that thing. On the profit as well as the dividend, you need to pay tax. But if you want to form a company it is more expensive. There are so documentary works that you should do, right? You need to issue shares to collect the funds, right? As well as if you need to incorporate, there are so many laws and regulations you need to follow. You need to pay the registrar of companies, right? You need to audit your company. If it is a sole proprietorship, you don't need to audit. But if it is a company, you should audit your company and you should provide the audit report as well. And also, agency problem is there. What is agency problem?
Managers
For their interest, managers
yeah.
managers act their self-interest, right? But how he should act?
Shareholder.
Shareholders' interest or else public interest. Clear? So you know shareholders invest fund. You you know, right? Shareholders, they invest, right? Funds. Managers are the person who act on behalf of the shareholders. So managers are accountable for to whom? Shareholders, right? So shareholders have some interest. They want what? Profit. They need return on their investment. Managers need what? They need salary, right? Bonus, increments, those things, incentives. Those are the things management, right? So that is the agency problem. Managers act on their interest, but shareholders need profit. Now there's a conflict. There's a conflict, no? They both are not in the same line, right? So that's the thing. In the audit, I think you will learn this agency problem in detail, right? Some online students are joining, within 5 minutes they are leaving. I don't know. Next, partnership. What is a partnership?
Who are managers getting together?
Getting together. Very good, right? Two or more partners or individual, they get into together to conduct a business with the intention of earning profit. That is called common goal should be there. What is the common goal? Earning profit, right? So that is partnership. But for the partnerships, unlike company, they have unlimited liability, right? If they don't have funds, if they bankrupted, they need to use their personal asset to settle those things. Easy and inexpensive form of organization, you know. Right now only, also you three together form a partnership. It's an easy thing. And partnership dissolves if one partner sells out or dies, you know. And amount of equity rise is limited. Why it is limited? Amount of rise equity is limited in partnership. You know, only you can select the funds from the partners. You can't go for outside, no. Therefore, it is like that. So income is taxed as a personal income, right? You don't have separate taxation for the partnership. It is taxed under personal name. So it's about partnerships. Next, sole proprietorship. What is sole proprietorship? It's owned by one person. Also managed by that same person, right? To earn profit. Normally raises capital from personal resources or borrowing and responsible for all business decisions, and he has unlimited liability, his or her total wealth, right? So you know those things. I'm not going to take much time on those things. Right. Who make the decisions? Very good. Shareholders not making decisions for the company. Managers, right? Professional manager, financial manager is the person who makes the decision